From the morning reading, FOMC, no change. SPX closes 2097. Oil slides lower. Breadth weakened compared to the prior session as decliners led 2314 to 720 on the New York Stock Exchange, and decliners led on the Nasdaq 2035 to 703. On the S&P 500 snapshot, 7 days in the red. Major equity markets around the globe were in sell-off mode. The benchmark S&P 500 posted a 0.65% loss, its seventh consecutive finish in the red. The last time that happened was in late November 2011, the seventh loss being the day after Thanksgiving. That November 2011 sell-off was quite a bit steeper at negative 7.88%. The session yesterday's 7-day slump is a more modest 2.48%. Should the 500 extend its slump the next session to 8 days, we'd have to look back to October of 2008 for a duration equivalent. But the size of that sell-off was a gut-wrenching minus 22.80%. The VIX fear gauge hit an intraday high yesterday above the 20 benchmark, but it remained in the below 20 throughout today's trade and ended the session at 19.34. The 10-year note closed the session at 1.81%, down 2 basis points from the previous close. There are some signs of panic in the high-yield bond market. Junk bonds have suffered large losses over the past week and a half, and it's beginning to show in several indicators. If we look at the composite model like we did last December, we can see that there are initial signs of panic exceeding the Brexit chaos in June, but not quite to the level of the get me out at all costs that occurred last year. The S&P dropped for the 7th day in a row. During bull markets, such streaks are rare and have had a different connotation than when they occur after stocks have already sold off for a while. Most often, there is even more selling pressure over the next 1 to 2 weeks. Equity option traders focused on puts almost as much as calls on Wednesday. The stock's only put-call ratio is rare during bull markets, occurring only 17 times in 20 years. More of our indicators are showing pessimism than optimism for the first time since June. Previous pullbacks have usually ended when the percentage of pessimistic indicators exceeds optimistic ones by at least 20%, or when the two switch again. And there are more optimistic than pessimistic indicators, meaning that currently we're stuck in an unfortunate period of rising but not yet extreme pessimism. Among the major sectors, healthcare stocks have faltered the most. Only 31% of stocks in the sector are trading above their 200-day averages, the worst of the sectors. Previous corrections have neared completion when 20% or fewer of the stocks are above their long-term averages, so there is further to go before we could conclude that the current level is truly extreme. Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:09 a.m. Mountain Time, and I'm recording this in preparation for the market day of November the 3rd, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. So, at the time of this cut, all four of the U.S. broad-based indices were positive. The S&P futures are up about 0.25%. The Russell futures are up about 0.5%. NASDAQ up just above scratch. And the Dow futures are up about 0.25%. Crude oil is up about 0.8%. Euro's down about 0.33%. Bonds are down almost 0.5%. And gold is down about 1.4%. In overseas action, China up about 0.8%. Hong Kong down about 0.5%. Japan doesn't look to be open today. That data is from 11/2. Germany is up just above scratch, and the United Kingdom is down just below scratch. In terms of macroeconomic reports for today in the United States, of note, we have the weekly unemployment claims, non-farm productivity, unit labor costs, ISM non-manufacturing PMI, factory orders, the weekly natural gas storage report. So quite a long list of macroeconomic reports today, even in the orange and red flag categories. In terms of current volatility, our short-term VIX now at 24.16, so quite high in relative terms. Skew also in the warning area at above a 125. And then IV percentiles continue to climb based on the last 52-week range. You have the S&P at a 55, the Russell at a 44, the NASDAQ at a 46, and the Dow at a 46. So in relative terms, this is in the middle of the range for the annual range, but compared to where we were in recent weeks, this is very much elevated. In the standard deviation moves, we had no standard deviation moves on any of the four broad-based U.S. indices in a close-to-close basis. Though some of these days, you know, when we say there's been no standard deviation moves, for example, in the rolling 2 weeks in the S&P, some of these days have certainly had wide-ranging price movement, but then closed within the one standard deviation move. So, you know, when it was all said and done, we've had a lot of movement, but not much achieved. Now, in recent days, of course, and we'll go ahead and go to the charts, we've had, you know, significant breakdown, but yet at the same time, it's been this kind of controlled pace of breakdown, really quite remarkable. In fact, I think one of the morning authors mentioned that even in 7 days, we'd only achieved something like a 2% loss. I'm looking for that number, 2.48%. So less than 2.5% loss in the last 7 sessions, even though they were all red. So quite remarkable that you could have such protracted and persistent negativity, bearishness in the broad market, and yet achieve nothing more than a 2.5% drawdown. So it has been a remarkably controlled weakness period. Now we clearly see the break of the horizontal support and then follow through with yesterday's action, a little bit of a bounce so far with today. But, you know, with this break of the key area of support, we definitely have a significant increase in risk. And we've talked about this, you know, in great length in recent sessions as this situation developed, and how important that area would be. Well, it's happened now, and now we have to kind of pay attention in terms of where might this go. And there's a couple things we can do. Certainly, we can consider what we might have is retracements. And we see here right now we've been playing with the 50% retracement area. And in the overnight, it did undercut that 50% retracement, but has come back up. And indeed, this could be a bounce area. Also, other potential bounce areas are 2061. And then if it gets past that, we probably go all the way to the 1980 area. So anywhere in here, we probably, if we're going to fall down to 1980, we're probably not going in a straight line. We probably will have a couple bounces along the way. So look for the potential for bear flags as these situations develop. Now, in terms of what would it take for the bulls to recover, well, we've seen undercuts in the past as we've had this long-term ranging market, and it's still possible that with this undercut, they could shake a few weak hands out and then come back into the range. So and we're still not far from that range. If we get a price action that takes us back up and closes up above 2100 and then starts to go into sideways consolidation back in the range again, we would just simply mark this off as a undercut and false breakout. So that's still in the realm of possibilities, but on balance, you have to say that the probabilities are that this market is significantly weak and doesn't show any signs that the bulls are going to be able to carry the day in the end in terms of the intermediate term. Now, the Dow has held up a little bit better. Remember that the Dow is composed of generally big cap, dividend paying type companies. So they often are more defensive in nature, and they will certainly hold up better oftentimes in times of weakness by virtue of their nature. So, the fact that this one's still holding its horizontal support isn't surprising, but put it in context. When you look at the Russell, big breakdown here, and certainly, it's heading towards the 618 retracement at this point. And then you have the NASDAQ, which of course had been the most bullish. Well, it certainly has had a big breakdown, now below the cloud, has not yet broken horizontal support from its last significant swing, but yet at the same time, clearly is broken down from where it was in its relative position. So where are we when you put all this together? You have a very, very weak Russell, which is your growth oriented. You have the tech sector, which is had a pretty dramatic fall off from what was in about 8 or 9 sessions ago a 52-week high, and has ever since then has been basically straight down. And then you have the broad market S&P 500, the benchmark, which is in clear break of key support. You had the most defensive Dow 30, which is still holding that area of support, but that would be generally expected to last the break. So that's kind of where we are in summation. Let's take a look at the other markets and see what they're telling us. Crude oil, of course, has also been in a significant drop, much like the NASDAQ. It set its own 52-week high, and ever since it set that 52-week high, which was a false breakout to the upside. We were just talking about what would it take for the S&P to get back to its prior range and basically create a false breakout to the downside. Well, you can see that these things do happen. You had a false breakout to the upside on crude oil, and then it has been negative ever since. Well, obviously, if the bulls were to come in on crude oil and turn this thing around and we start to see higher highs again, the overall premise would still be intact. The prior swing here this is the last prior swing low of real significance. Obviously there's some swings here, minor, but if this area were to hold and we were to turn around and then go immediately and make a new swing high, it would just simply be a bit of a consolidation, a bit more of a serious consolidation, but a bit of a consolidation in an intermediate term time frame, and nothing more than that. So this is kind of coming into a really important area. If the 618, which coincides with this level of support on the horizontal price action, if that doesn't hold, then we probably also see a move all the way to the 100% retracement. So there you are with crude oil. Now, of course, the dollar is playing a role in this, and the dollar weakness continues to drive some of this behavior in markets like crude oil and gold. And gold, we continue to see this kind of important action coming up back to the prior area of support, now turned resistance. We talked about this before yesterday's market, and sure enough, it went up and just tickled that area and then fell back in a pretty pronounced way. And last night's action also went up, tickled the area again, and then has fallen back. So that does indeed seem to be a fairly significant area of resistance for gold. We'll have to wait and see if it's able to break through that area. Certainly, if the dollar continues to fall, we may very well see that happen. But you see on the reverse, inverse correlation with the dollar, it fell and then has reversed and has made up much of the ground since it opened with the overnight session. In terms of, let's go to bonds. Bonds pretty much in a sideways consolidation pattern. And certainly while gold has had some movement, bonds have had some movement. And we've had 7 days in a row of negative activity on the broad market indices. We've not seen this huge run to safe haven status in the bonds or gold markets. So it's been a very, very controlled bearish market for equities thus far. In terms of volatility, obviously volatility has been in this kind of significant, yet at the same time, we've made this whole move without having a VIX spike. And remember, we defined that as a close to close of at least 3 points difference. And even this one, when we go from say 1706 to 1856, that's only 1.5 points. What we're looking for is a 3-point spike. That's like this one here on 9/9. We've had this whole deterioration kind of in a slow motion, kind of almost Hollywood type of approach. And yes, we're up here in significant areas. We're currently playing in the 19 handle and have tickled in the 20 handle in recent sessions. But that being said, it's been a very, very kind of controlled manner in which this has happened. Perhaps because the real resolution to all this market volatility is the election, and we know when the election and when that information is going to be available, that's kind of controlling the pace of the fear premium, as it were. That's probably enough on the charts. Let's go ahead and go to the daily report. Daily report continues to be very, very negative. We've had, of course, with our intermediate term phase opinion, market phase 5 is the current characterization, the break of diagonal and horizontal support on our key benchmark market of the S&P. In terms of the 3 market timing signals, uptrend under pressure. I've frankly been a little surprised that hasn't already deteriorated to the next level, but it still is uptrend under pressure. GMI index is at a full out sell signal, a 1 out of 6 on the first indicator, a 0 out of 8 on the second indicator. That sell signal has been in place since 10/12. Decision point scoreboard, we didn't have any changes with yesterday's action, but we're already decidedly weak on this indicator. In the short term, neutral to bearish across all 4 markets here that are defined, and then on the intermediate term, neutral to bearish on 3 of the 4, and then of course the mixed neutral signals that are coming in on the long term. So consensus of all this is very much neutral to bearish, and not much there for the bulls to hang their hat on. In terms of position sizing opinions, first model is 50%, second model also 50%. Intermediate term market posture, severely strong bear signal reinforced with a weak bear sentiment line. So the S&P is now fallen below a 20, currently at a 17.0. NASDAQ also severely strong bear, fallen also below the 20. The Russell's about as negative as it can be at a 4.1. Now remember, any of this activity, it can bounce back up and still stay below 20. Anything that's below a 20 is considered severely strong bears. It's not until the curve turns up and rises above a 20 that we go to a weak bull. So these are very, very poor signs for the bulls at this time. Hedge warning status, we've gone to full out level 3 with that key break of support, the horizontal support, and with that confirmation of that activity, the significant potential for something of 100-point drop is absolutely in play. Now, it's not a prediction that we're going to 1980 or any kind of probability numbers around that, but what we're saying is that the conditions are favorable for significant drop activity. Liken this to the weatherman who, looks at the various variables and makes a comment that, significant thunderstorms, severe thunderstorms perhaps, and perhaps even the chance for tornadoes might be in the weather forecast for the day as the situation develops. Well, very much in the same kind of analogy, all those conditions are present for the market condition at this time. Now, that being said, whether those actual storm cells will truly follow through and where they might hit and how hard they might hit and whether you might get just severe storms versus hailstorms versus even tornadoes, that's yet to be determined. But the conditions are ripe for all of those possibilities to come into play. So this is our highest hedge warning level status. And, we're not yet in a full out kind of bear market or recession kind of cycle right now. This is within the context of, correction type activity within a bull market. But certainly this is for a bull market about as ugly as it can get. So, perhaps you could characterize a level 3 in the current market versus a level 3 in, say, February of 2009, when you're in the throes of a outright bear market. But this is a very serious level, hedge risk level warning. In terms of strategy opinions, obviously all three of these strategies are basically off the table for the initiation of new positions for novice traders. And really only very, very aggressive traders should be looking to step in front of this in terms of bullish setups at this point. Now, obviously, it is very much in play to be setting up some bearish trades with the current market position. So when we go to the individual warning areas, you can see a sea of red, literally everything that can be read, save one indicator. We never did get a VIX spike in this current move, but everything else is red. Distribution day counts continue to climb. Just everything's in play. And the trend base, all three are in play. Look at the new highs, new lows. We've had day after day after day where the new lows are well over 300. Key intermarket risk aversion indicators, all 5 are in risk-off posture. In terms of sentiment, we're in extreme fear. We've dropped now down to an 17. In terms of sector-specific, you can see there's very, very little green represented for yesterday, and not even in the defensive sectors. In fact, many of the defensive sectors are amongst the worst performers. Real estate, utilities, telecom, and of course bonds yesterday. Bonds held up in a relative sense fairly well, but certainly were not the kind of risk-off, run-to-safe haven status, kind of premise that we would often see. So I think this is partly in reflection of this kind of slow motion deterioration that we've seen thus far. In terms of market posture by sector specific, it's a sea of red in the short to intermediate term, and much of the long term, really, there's not much there for the bulls to hold on to. In terms of percent change across the various time frames, you can see 1 day, 5 day, 1 month, 3 month, really very little green for all the activity of the last rolling quarter. Any more negativity at all, and we'll likely see everything within the last 3 months go red. So that's enough for today. We're up over 20 minutes. We've had some long sessions here of late. Obviously, some very important market action as we've kind of anticipated this deterioration, and yet at the same time, we have to give the bulls some credit in that they've kind of held the pace thus far. So we'll see where this further develops, but certainly the hedge warning status at level 3, we should be very much a very cautionary kind of stance in terms of our current trading activity. I'm going to roll through these slides. If you see anything of interest, just hit the pause button and go back for more information. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll be back here for the next session from Falcon Global in the market preview for tomorrow. In the meantime, manage that risk, and as always, that should go a very long way towards keeping you consistent in your performance. Good trading.